An introduction to property metrics. Metrics are important to every property investor and provide a way to analyze current and future investments. The outcome from this analysis will invariably drive a decision-making process. The most common will be whether to buy or sell a property. Analysis is often done using benchmarking techniques, where one set of data is compared to another. For this comparison to be meaningful, the data set, which is the data being compared against, should be relevant and up-to-date. For property investors, there are lots of sources of benchmark data, including land registry, property portals, and historical performance. One of the most important metrics for a property investor is the return a property can generate. This is known as its yield. The yield is expressed as a percentage and are based on annual figures. There are two types of yields. Gross yield is the annual income generated by a property divided by its price. For example, a buy-to-let property is tenanted and generates a gross rental income per year of £20,000. If the property originally cost £100,000, it generates an annual gross yield of 20%. Net yield is the annual profit, income minus costs, generated by a property divided by its price. For example, a buy-to-let property is tenanted and generates a gross rental income per year of £20,000 with annual costs of £10,000. If the property originally cost £100,000, it generates an annual net yield of 10%. Another important metric for an investor is a property's return on investment, also known as its ROI. Return on investment is the annual profit, income minus costs, generated by a property divided by the cash an investor has invested. For example, a buy-to-let property is tenanted and generates a gross rental income per year of £20,000 with annual costs of £10,000. If the property originally cost £100,000 and the landlord bought it using a mortgage and invested a cash deposit of £20,000, it generates an ROI of 50%. Return on investment is also referred to as return on cash or return on capital employed. They mean the same thing. It's important for investors to remember that these metrics are based on historic rental income only and do not take into consideration any future events, such as capital growth that a property may experience. As the future is hard to predict, it is advisable to not rely heavily on any metrics that forecast the future. As well as metrics that look at the performance of a property through the rental income it generates, there is also a metric that looks at the income a property is not generating. This is known as its void periods. Void periods related to the times a property is not occupied and therefore not generating a rental income. Voids are expressed as a percentage and are based on annual figures. For example, a buy-to-let property is occupied by a tenant for 6 months per year. As the property is empty and unoccupied for the remaining 6 months, its void period is 50%. Void periods can happen for several reasons, such as the time between a change in tenants, but are very important for an investor to understand the true performance of their property investment. Another metric that is important is the loan to value, also known as LTV, particularly if you are raising finance. Typically, a finance company will lend you a percentage of the property value. This can be between 50% to 80% depending on how the lender views the risk. Most mortgage lenders offer terms based on a 75% LTV, which means they will lend you 75% of the property value and you must put in 25%. Finally, it's important to remember that most property metrics are calculated before the impact of tax. Taxes include income tax, corporation tax, and capital gains tax, and will all reduce the investment performance of a property, so make sure you seek professional advice when planning to purchase or sell.